All right, had some technical difficulties earlier, but Mike Apple joins us now. Good morning, Michael. How are you, sir?
Good morning. I'm well, Roger. How are you?
I'm very good. The markets are doing well, except
nice
it's
start.
August, right?
Yeah, well, you know what? Last week we saw huge swings, and it appears that this week we're probably going to see more of the same, where you give investors 24 hours and the psychology completely changes. It's remarkable.
What is it's low? I know you said it's low volumes, but there must be some psychological thing too. Maybe everybody's on vacation a little bit, like in their minds they're on vacation.
That works into it certainly, but a week ago, what were we talking about? Record or multi-year lows for bond yields, and everybody was freaked out about the global economy slowing down because the bond market was signaling that. It may or may not transpire that way, but money flows from one asset class to the other. So last week, everybody was putting money into bonds and gold. And then somebody went, okay, that's had a nice run. Back we go to the stocks.
Yeah.
So Friday, the Dow was up 309. This morning, we've got the Dow futures up 275 already. China is sending out signals that their central bank is ready for interest rate reform, which is code for cutting interest rates. They've lowered their currency, the yuan, to offset the tariff battle with the United States. It's an economic signal that they're ready to bolster the economy. So what happens? Stocks move up. We've got the Chinese benchmarks today, many of them up by 3%. They're also looking to offset the risk, economically speaking, from the ongoing protests in Hong Kong. Massive scenes of civil protest over the weekend in Hong Kong, pushing back against China. And, that also plays itself out into all the uncertainty.
Nervous, right? Yeah,
it's all about uncertainty, nervous. Right? So.
Let's talk quickly, the banks coming out with their earnings.
Yes, and they're going to make lots of money. We'll hear all sorts of about billion-dollar-plus profits. From an investor standpoint, though, these big banks of ours have been underperformers. Last week, we talked about the CIBC, for example, hitting a 2-year low for its stock price. Worries about falling bond yields. Jitters about the economy. The mortgage market. Is it good? Is it bad? We'll hear from the CEOs over the course of this week. I wanted to mention, too, Roger, in Denmark, first of its kind, negative interest rate mortgage.
This can't be healthy, though.
No, it's not.
It can't be healthy at all.
This is a sign about Europe's economy still struggling. They've never really recuperated fully out of the economic crisis. The Greek debt crisis, worries about Italian debt, all of that, earlier this decade. Denmark has a 0.5% negative mortgage rate right now, trying to get people to buy homes.
Why? Okay, so, what is the point of that? The idea of being in 5 years or something when it comes time to renew, or 10 years?
Negative. They're basically, the banks are offering free money for all intents and purposes. Germany's mortgage rates are down to about 1%. Here in Canada, we're only around 2.75%. Some of the posted rates of the big banks. So I mean, it's pretty. And you're trying to avoid a bubble in an asset class. Well, boy, oh boy, they're actually trying to inflate something right now in the European market.
Yeah, that is. I mean, how is it working for the banks? How are they making money? Well,
they offset it in other ways because they say, well, we can afford to do this right now. But you're right; it sounds like a money-losing proposition, doesn't it? But I mean, you got to keep the wheels greased, so to speak. So they're just doing anything and everything. And don't forget, last week Trump wanted to buy Greenland from Denmark. So
maybe it's for sale.
Maybe they're all their protest sanctions. They don't want to dismiss it. That's not for sale. Well,
pick up a negative 0.5% mortgage on Greenland.
Yeah, it's a real estate deal of the decade.
All right, a deal at twice the price. Mike, thank you very much, sir.
Thank you.
Cheers.